Silver is still controlled, no question about it. But when you talk about, in terms of the amount of silver that's being accumulated here in the United States, since Easter, at least almost, and I haven't updated it since last week, but since Easter, about 12,000 silver contracts have been delivered. That's almost 2,000 tons of silver. That's not a small amount, and it's not, that's something that should be understood and not glossed over, because the price has not done what it's supposed to do. And I think, people get so tired of hearing that, because it's been that way for quite some time. They perhaps are becoming disenchanted, but yet there's money here in the United States at a higher level that understands what's happening, that is standing for delivery in quantities that we've never ever seen before. I think that, to me, is one of the biggest things that I would focus on. And in so far on the May contract in silver, which is an active delivery month, there has been, let's see here, it's record pace. So far, as of Friday of last week, 13,581 contracts have been delivered. That's an all-time high. And one of the things that is unusual about it is that almost 3,200 contracts, about 16 million ounces, were delivered from the banks to non-banks. Now, we're not seeing the same thing with gold, where banks are delivering as much to non-banks. I don't know when QE doing, I don't know how far back we go on this, but over the last year or two, the banks have quietly offloaded over 110 million ounces of silver to non-bank entities. Who are these non-bank entities? I'm not quite sure. To me, this screams that institutions like the banks are frightened of silver and maybe are getting out, while others, the industrials or military industrial complexes, standing for delivery on all of this stuff. You can only hold down the price of any commodity or manipulate it over an extended period of time by pushing it in the direction that it is going. You have China doing interviews with Sean Kunkun and others in the resource space have said to me, Andy, China is buying all throughout South America, in particular Peru, and they're buying up all the doré and the concentrate. The doré are crudely refined bars, and the concentrate is a byproduct sludge, paying double what the West will, and sending it back to China for refining. Well, why would the second largest producer of silver in the world need to do that? Buying this stuff and then sending it back, paying over market price and sending it back for refining. Well, it disintermediates the market, disintermediates the price. No one knows how much they're buying, and they go to the source. Russia says, well, we're going to add it to our strategic stockpile. India has bought over 900 million ounces in the last 5 years, probably more than that. That's just what we can calculate. And so you have massive money that has been using the suppression. If you look at the LBMA, David Jensen does an amazing job of talking about the rehypothecation there. And even though the numbers that I'm going to give you are a little lower because of all the deliveries, last month they had, in essence, 800 million ounces. Now it's down to 7 something now. But 800 million ounces was the entire stockpile of silver at the LBMA, of which 500 million was encumbered by the ETFs, like SLV, like Bullion Vault, leaving 300 million ounces, and the number was 290. And they say that they trade 290 million ounces a day, the entire float, what is available every day. They trade that. However, as David Jensen mentioned, he said, look, they've admitted through surveys of all the bullion banks there that they are trading at least up to 10 times that posted number, because they only post the settlement numbers, the final settlement. So that would mean they're trading 2.9 to 3 billion ounces of silver per day, 10 times the float, 3.5 times annual global mine supply, and it's all naked. So this is the existential threat. And if you believe that the banks in the United States have gone long in London, are trying to cover and deliver out of their shorts in the United States, there is a theory out there, Tom Luongo talks about it, that Trump is angry at the European aristocrats and the Bank of England. And this is how he gets back at them, by draining the exchanges and exposing the rehypothecation at the LBMA and blowing up some of these European banks and ultimately the Bank of England. Now, this is a theory. I'm not saying it's mine, but when you look at the LBMA trading these extraordinarily rehypothecated numbers, especially in silver, when you see the banks here in the US kind of looking like they're getting out here, intimating that they're long there against their shorts here, and at the time, you see the LBMA say in the Bank of England, yeah, we got to go to 8 weeks instead of 1 day. Sorry, we don't have enough trucks or manpower. Something is going on with gold and silver. Again, the price is the greatest tool of misdirection, and it's a high stakes game. You have the biggest banks in the world. It's an existential threat to their survival. To me, the term asymmetrical comes to mind when I think of silver, the lowest downside with the best upside, but you better have strong fingertips and better be able to tune out the noise, because the noise will drive you insane. And the long-term technical fundamentals look extraordinary. This, huge cup and handle, and it's just about to break through a declining wedge. A very bullish technical factor. We're right there. I guess only time will tell.
So let's talk about the elephant in the vault, silver. Now, I've said it before, and I'll say it again. Silver is the most undervalued, mispriced, and suppressed asset on the planet. And that's not just hyperbole. That's coming from looking at the numbers, watching the flows, and listening to the signals the market isn't saying out loud. People get frustrated when they look at the price of silver and say it's not doing what it's supposed to do. And they're right. But that's not because silver's broken. It's because the pricing mechanism is broken. Take this. Since Easter, just here in the United States, over 12,000 silver contracts have been delivered. That's not nothing. That's not a rounding error. We're talking nearly 2,000 tons of silver, and that's as of last week. I haven't even updated it yet, and I can tell you with confidence, it's probably even more now. Now stop and ask yourself, how can you have record physical deliveries and record open interest in standing for delivery, and the price doesn't move? In fact, it drops. If that doesn't scream manipulation, I don't know what does. Let's put this in perspective. In the May silver contract, which is an active delivery month, over 13,581 contracts have already been delivered. That's an all-time record. Never happened before. And here's the part that really matters. Over 3,200 contracts, or about 16 million ounces, were delivered from banks to non-bank entities. Now, why does that matter? Because you're not seeing the same thing in gold. Banks are quietly offloading silver. In fact, over the past couple of years, they've dumped more than 110 million ounces to non-bank buyers. Who are these entities? Nobody knows. They're off the radar. My guess, institutions. Maybe the military-industrial complex. Maybe industrials like solar and tech. Maybe strategic stockpile actors. What's clear is that the banks don't want to be holding silver anymore. Now remember, these are the same banks that spent years shorting silver. Naked, through the COMEX, suppressing price, playing paper games, rehypothecating supply. And now they're exiting? They're handing over ounces to unknown buyers while the price is sitting flat? That's not market action. That's something very deliberate. And then you have China, working backdoor channels through South America. And I've had people, Sean Kungun, people I trust in the resource space, tell me directly, China is buying everything. Door bars, concentrates, anything they can get. And they're paying over market, sometimes double, just to get the silver before it's refined. Now think about that. Why would the second largest producer of silver in the world, China, be buying raw silver product from other countries at a premium and sending it home to refine? Because it disintermediates the market. No one can track what they're buying. It keeps the official numbers fuzzy. It keeps the West in the dark. Russia? Same story. We're adding it to our strategic stockpile, they say. India? Quietly buying 900 million ounces of silver in the last 5 years. That's just what we can confirm. I'd bet it's well over $1 billion at this point. So what you've got is the smart money, the strategic players, using the artificially suppressed price, which, let's be honest, is a result of decades-long paper manipulation, to accumulate real silver in size. Meanwhile, retail investors are getting disenchanted. They're looking at 32 silver watching it get smashed on zero news and thinking, maybe I'll sit this one out. That's exactly what they want. Because if you knew what was actually going on under the surface, the inventory drawdowns, the EFP arbitrage, the vault depletion, the record deliveries, and the unrelenting Eastern accumulation, you wouldn't be asking, why isn't silver moving? You'd be asking, why can I still buy it at this price? Let me give you some perspective on the London Bullion Market Association, LBMA, which is ground zero for the paper gold and silver pricing illusion. As of last month, the LBMA reported about 700 million ounces in silver inventory. Sounds like a lot, right? But wait, more than 500 million of those ounces are already spoken for. They're tied up in ETFs like SLV or Bullion Vault Services. That leaves under 200 million ounces available for delivery. And guess what? The LBMA trades that entire float every single day. Now that's the official story, but David Jensen, a brilliant guy in the space, broke this down beautifully. The LBMA only reports settled trades. They don't report volume that's opened, reversed, rehypothecated, or offset. According to internal surveys of bullion banks, actual volume is 10 times the reported amount. That means the LBMA is trading 2.9 to 3 billion ounces of silver per day. That's 3.5 times the entire annual global mine supply. And it's all naked.
Certainly India is continuing to accumulate gold, and maybe it's just too new and hasn't really broken out into something more than some skirmishes. Maybe if it were to become evident that this is getting very scary, it would, and it should. I mean, look, in the West, the market is too reactionary. You could argue that the folks in India and in China and that part of the world have been accumulating so much gold and silver for so long that it has less of an effect over there than it normally would. It should manifest itself here. And what do we see instead? We see people moving away from the risk off trade into the risk on trade. And it just goes to show that the masses are typically always in the wrong place at the wrong time. And that's why guys like Rick Rule, who have made a fortune, have done so as being a contrarian. And he's famous for saying, if you're not a contrarian, you'll be a victim. Well, right now, that is kind of what the world is saying. And I wouldn't look to the gold price, which has been for a very long time managed for several reasons, although I would argue that they've lost the ability to manage gold. Not yet silver. I would argue that China is controlling gold more than the West is ultimately. And so, rising gold is something that doesn't benefit any of these players really rising gold yet until the final resolution or the final understanding that if you don't get whatever isn't nailed down, it's too late. Well, we're not there yet, but I wouldn't look to that. I think that's maybe slightly misleading, and maybe it's not as severe as we are being led to believe, since there is a pause. Cooler heads are prevailing, let's hope. But everything that I've ever noticed about war, Guy, is that we would think the price should be going higher, and the players that like to manage its price, well, they will delink that rationale. They will delink the people's belief that when things get scary, you should run to gold, and they do it by shorting the paper price. And it kind of, don't look here, just keep on walking. And China's involved in that too. They want to continue to accumulate as much gold as possible. So by shorting the price during these conflicts, or not allowing it to run quite the way that it should as a result of it, makes people think, maybe I should buy Bitcoin instead, or buy something else. At the same time, they're doubling down their own accumulation efforts off of a lower price. So that's been kind of part of the playbook for a very long time, and ultimately will accentuate itself. But the immediacy, and that's just it. People in this country are always looking for a reason. Well, the market went down because, for this reason. Oh, well, that's great. Now I feel better. There's a lot more to all of this than just something like a skirmish between two angry nuclear powers. That's bad enough as it is, but maybe if it broke into something far more frightening, we would see gold finally start to move as a result of that.
Now let's zoom out even further and ask, why now? Why is all of this accelerating right here, right now? Because we're approaching the end of the road for the debt-based monetary experiment the world has been on since 1971. when Nixon closed the gold window and unleashed fiat currencies with no restraints. That system is now running on fumes. The global economy has reached a point where currency confidence is eroding, central banks are trapped, and physical assets, real, tangible, deliverable assets, are the last safe harbor. And silver, quite frankly, is ground zero for the fracture. This is no longer just about supply and demand in the industrial space. Solar panels, EVs, electronics. That story is strong, sure. But what I'm talking about is something bigger. A financial system seeking a reset, and silver being the fuse. You can already feel the stress fractures forming. Interest rates are being manipulated to suppress inflation, but they're killing bank balance sheets. Global debt is surging past $300 trillion. And despite all the hawkish talk, central banks can't tighten meaningfully without blowing up their own government's ability to finance. So what's the exit? Physical, real, honest money. Look, gold's resurgence isn't accidental. The world's central banks know exactly what's happening. Since 2022, they've been buying record amounts of gold, the most since the 1950s. These aren't speculative purchases. This is monetary repositioning. But silver? Silver is gold's leveraged twin. And unlike gold, it flies under the radar. Silver is off the radar of most institutions because of its volatility. It's more volatile than gold, sure, but that volatility cuts both ways. And when silver gets going, it goes parabolic. You think 32 silver is expensive? Let me give you a different framing. When gold was at $2,000, silver was $30. Today, gold's at $3,200 and silver's barely moved. From $2,000 to $3,200, that's a 60% gain. Silver? Maybe 10%. Do you really believe that's because demand isn't there? Or is it because the suppression mechanism is running on its last legs and the tape is being painted with increasing desperation? Here's where things get truly interesting. And I want you to pay close attention to this. We are now seeing non-bank entities stand for delivery in record numbers. That is a tectonic shift. It means people with real money, institutional-grade money, are stepping in, taking metal out of the system, and walking away with title in hand. Let me remind you, the vast majority of silver deliveries historically were shuffled between bank accounts, with the metal remaining in the system. Now, we're watching silver leave the vaults, go dark, and not come back. That's not investment. That's preparation. That's players making sure they have control over the asset, outside the reach of exchanges and counterparties. And while the Western financial media obsesses over Nvidia's earnings and Bitcoin's next halving, China, Russia, India, and sovereign wealth funds across the Middle East are quietly draining the real metal supply. They're paying premiums, they're tolerating logistical delays, and they're accumulating in size. Why? Because they see where this is going. They know that when trust in fiat breaks, and we are dangerously close to that point, the only thing that will hold value across borders without a counterparty is metal. And silver for them is an essential component of that strategy. Why? Because unlike gold, silver's supply chain is tighter, thinner, and less elastic. Mines aren't increasing output. If anything, they're contracting. And silver's dependence on base metal mining means that any global recession will further shrink supply. This is the perfect storm. Rising physical demand, collapsing trust in paper contracts, EFP backdoors draining inventory, naked shorts stretching the system, and no price discovery mechanism left that reflects any of it. What does that lead to? Asymmetric repricing. Now let me shift to something technical, because while I don't trade based on charts, I pay attention when the fundamentals and the technicals line up. Right now, silver is completing a giant multi-year cup and handle pattern, one of the most powerful bullish formations in all of technical analysis. And we're right at the breakout point, just inches away from blowing through a declining wedge that's been compressing since 2021. If this pattern resolves higher, and with this much pressure building underneath, I believe it must, we are going to see air pockets above the chart. No resistance, no supply, just vertical. This isn't just about returning to the 2011 high of $50. That's just the first stop. If the gold to silver ratio reverts from 100 to 1 to 50 to 1, which is conservative, and gold hits $4,500, you're looking at $90 silver. If we overshoot and the ratio touches 30 to 1, something we saw in the 1980s, you're talking triple-digit silver. And all of this, mind you, with very little downside. That's what I mean when I say silver is the most asymmetrical trade in the world today. You're not betting on a hype story, you're betting on a suppressed asset that's becoming harder to manipulate as physical demand takes control of price. And here's the irony. The more they push the price down, the more metal gets drained from the system, and the more it gets drained, the faster and more violent the repricing will be when the rubber band snaps. That's not a guess. That's what the history of suppressed markets always shows. When you bottleneck supply and then suddenly release it, you don't get rational moves. You get gaps, jumps, shocks. So I'll say it again. Silver is the fuse, and it's burning quickly. For the people still asking, when will silver move? I've got news for you. It already is. Not in the price, not yet, but in the structure, in the delivery volume, in the inventory drain, in the bid-ask spreads in Asia, in the physical premiums, in the Chicago Board of Trade, open interest, in the ETF outflows, in the weekly London clearing data. It's all there, hiding in plain sight. And when the price finally catches up to the truth, it won't walk. It'll sprint. So what do? You hold, you accumulate, you ignore the noise. You understand that this is a once-in-a-generation repricing event, unfolding in slow motion until it isn't. Don't be the one who says, I knew it, but I didn't act. Because when this goes, it'll be too late to get in at $32.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.